Hello everyone, it's me the Boss Hog. We're back with another video for the end of January 2024 about building my wealth and my road to 5 million. Not much change at surface level month on month, but quite a lot going underneath, and honestly I'm pretty happy with this number. There's also some pretty exciting news because we now have year-on-year data, so we can go back and see that we're up over 100,000 across the last 12 months. That feels really good, and we're going to talk about what's been driving that and where we're going next. Let's do it. Okay, so first I should probably explain why my wall looks a bit different. That is because my wife is getting our flat ready for my daughter's birthday party this weekend, so a little bit of a quirky background. That's not a new feature, I promise, but I thought I should explain it. I'm having to have all these conversations at work as well, as we've been going through the week, so that's been fun. Anyway, back here to wealth and targets, etc. There's a few things to highlight. So first of all, in terms of our change month on month, there was a slight drop. Honestly, until the last Friday of the month, it was actually a slight increase. Within this, though, I'm pretty happy with such a modest change. Like most of my investments in terms of stocks were broadly speaking flat across the month, both in terms of my pensions and my ISAs, as we'll get to shortly. And then we paid off my wife's HMRC tax bill, so that was 4 grand. And we also paid off our holiday as well, which was another 4 grand. So we weren't originally planning on such an expensive holiday, frankly, but we did really well on our targets last year, and we found a great place that we're going to be going to over Easter. That looks lovely. So a nice 5-star hotel in Portugal. So it should be excellent for my family. So that aside, I'm actually pretty pleased because that's 8 grand's worth of outlay, and we more or less stayed still in the month. More exciting to me is actually our year-on-year figure now. Like it's very easy to get sort of caught up in the month change. Sometimes it goes down, right? Sometimes quite significantly month on month. Other times it goes up. But when you actually look at this across a long period of time, a year ago exactly we had 344,000, and now we're at 458,459 if I was to round up. So the difference year on year is over 114,000. You can see it there in my new table in the middle. And even quarter on quarter, we're up 65,000, which is pretty huge quarter on quarter. Again, my wife had a bonus. We've had great stock market performance over that time as well. So there are reasons for that. I wouldn't expect to make that every year, but again, we've only got 20 years to get from this figure to 5 million, so we do need to have 6-figure years, and and I guess it should be increasing over time on average. We may well have a 12-month period where things go down if it's really bad. I can imagine a world where that would happen, although I think it would have to be quite a big drop, but we will see. 2 decades is still a fairly long time, so a lot can happen over that period. But yeah, despite the drop, like I say, I'm actually really happy. We are slightly behind on our targets at the moment, but again, that's not a huge shock to me. And I would expect to catch up eventually because some of my growth targets in terms of things like wages and costs are very pessimistic and don't include things like like bonuses, sorry. But then at the same time, we have changed our focus a little bit, for example, relaxing our holiday spend and things like that. So yeah, we have a net worth of 458,500, down slightly month on month, but up very significantly year on year, sort of 33% rise there, which again is huge in a year. Obviously, as we get a bigger pot here and a bigger wealth, our percentage increase will go down because maths. But the important thing here for me and the bit that made me feel best was the year-on-year comparison there, up 114,500 pounds. So a really good figure, and we're going to keep this up hopefully for the next couple of decades. Okay, so in terms of our contributions to wealth, so this is the thing we can most control, right? So although across the last year we've seen a 115k increase in our wealth, across 2023, 77,000 of that was ultimately our contributions, with the rest being growth in various assets, etc. As you can see there in the 2023 total, which we're going to keep for the rest of the year just to see how we're comparing against it. 2023, I was really happy though. We smashed targets, what I thought was a fairly ambitious target. So I felt really great about that. Again, part of that was my wife's performance at work. She's been being a superstar, so that was a nice, pleasant surprise against those numbers. But to beat what I thought was an ambitious target by 10% feels really good. This year I've probably been too ambitious, and I'd love to get to 100,000 just because of the roundness of the number, right? And it's 100,000, but I think that is quite ambitious, and I'm not really expecting to hit it. I think a lot of things would have to go really well. I think 90k is more achievable. The 90k feels as hard as the 70k though, so I don't know whether again in a few months' time we'll be talking about smashing it. That would be nice. Currently, we're on track for 96,000 across the year, and if we can hit those kind of numbers, then that would be awesome. Now, I would say it's a fairly slow start. So the Jan 24 figure there, you can see it's under 3,000. But again, you can see a lot of negatives down there as well. So our non-ISA investments actually went down, and that was because we were moving money from a current account essentially, or a savings account that's linked to my mortgage, so my offset mortgage, and to pay for things like the tax bill, like the holiday, etc. And we also, continue to use our credit card actively for debt arbitrage. And just as a reminder for anyone who's new, I have a 13k credit limit credit card, which is now up to 12k. So we're basically finished. But within that, an agreement I had with my wife is that we should have sufficient assets to cover that. So we do. We'll look at the details very shortly. But that's now mapped out as well. So quite big movements here. And those negatives are offset by the contribution to our ISA, which was almost 8,500 this month. And that was because we moved some money, and we also used it as an opportunity to max out our ISAs. Like Trading 212, my brokerage now has 5% cash. That's tax free for me as well, which is basically as good as I can get anywhere else. So I decided to, move the money into the ISAs, top it up early. And what it also means is for February and March, because I don't have anywhere else, any remaining allowance left in my ISAs, is we'll start looking at non-ISA investments. So primarily it's going to be going into premium bonds, and you'll see here that figure with the minus 2,500. That's going to reverse next month. The debt arbitrage will be close to zero next month, and we'll have a relatively normal looking month, I think, as sort of, the holidays, the tax bills, etc. are behind us now. And it should look more normal. The other nice thing that I'm expecting next month is my wife got a promotion and a pay rise at work, so my wife's pension contributions from February will be a little bit higher as well. And again, that was one of my actions to understand in January, and is later in this video as well. So that there's some good stuff there. I also expect personally to get a pay rise from April and a bonus at the end of March. Don't know the numbers yet. My company is still working through the numbers. But it should be very low 5 figures is my expectation, and then the taxman will take half of it because that's how taxes work, unfortunately, in the UK. So it is what it is. But it should still make a fairly sizable contribution to this, as well as sort of a more modest but not trivial pay rise that I would expect to get in a few months as well. So there is some exciting stuff during the year that should help us move from 76 to potentially 96,000 as well. All right, so we've got some new data here in the graph in the top right. This is basically my other pension, home, and ISA, so it matches the table underneath. And I changed the way that I was doing this from the sort of graph previously into, I think, a clearer stacked graph. And again, we can kind of see it changing over time. They're quite big jumps on the y-axis, right? So it doesn't look like potentially that big of an increase. But as we've already touched on, this is 114,000. And you can see the changes in both the summary table there as well as the bigger table. So there's been a few changes across the year, but the important thing here is the 114 matches with what we'd already touched on. You can see here the new bank accounts for my cash savings in Sant Edge, as well as the monthly saver. So the Sant Edge is especially nice, Santander Edge saver account, and that's 7%. Up to 4 grand, so needless to say I'm keeping 4 grand in there. That also pays monthly as well. So what I did this month is literally I got my interest on the month, and then I just moved it into my current account because I don't get 7% on the 7%. So there's no benefit for me having anything above 4,000 in there. Obviously I wish that was higher, but I love 7% as a 100% safety net. So we've just matched that out. The monthly saver is the line above. That works a little bit differently because effectively I put in £200 a month, and then at the end of the year, after I've made 12 £200 deposits or up to £200 deposits, then I get 5%. So it'd be something like £60 at the end of the year. Again, not a huge amount in isolation, but these things all add up, right? £25 a month for the 4 grand. Then I've got this £60 in 11 months time, and I've been making some changes as well to basically bank accounts and where cash sits as well. So I expect to make more than £500 this year across my banking interest, cashbacks as well, and my brokerage cash interest that we've just touched on as well, the 5% there. So it should be great. Our overall debt arbitrage is 2,000 plus 2,000. So you can see here where it says credit card arbitrage right at the very bottom, a smidge under 12k. I'm basically going to put the card in my drawer now from the 1st of February, so we won't be using this anymore. And then obviously we will always have this money to cover it whenever the interest rate starts to be charged again, but it's 0% for the next 13 months or so. It's a 15-month total, 0%. And at the end of that period, my wife would actually like to pay it off. I'm trying to convince her that it would be great if we could just roll it forward a bit more, but we'll decide. Well, the important thing for me in my agreement with my missus is that we have sufficient cash deposits to cover it. So that's basically premium bonds plus savings accounts should always be greater than the credit card. And at the moment, it's higher than 2,000. Last month, we had a much bigger figure, but that was because we had a lot of money still sitting in cash from my wife's bonus, basically, that was sitting in the offset account, as I've already mentioned. So that's now been distributed, and we remain, though, importantly, above our credit amount. I think other important things to mention is my nutmeg pensions, both for my wife and me, that are up quite significantly year on year. This is significant, especially for me, because I don't make regular contributions into it. It's my consolidated old pensions. So the 7.5K performance there is basically 11% return across the 12 months because I haven't added any capital to it. Now it's interesting. I was chatting with some people in Discord because even though 11% is above my long-term projection of 6%. For this account, I was actually a bit disappointed with it. And when I looked into the fund, it had a lot of details about more defensive holdings, ESG investments that I really don't care for and actually disagree with. I don't think you need to incentivize well-performing companies. And yeah, I'm quite against ESG as an investment. And a lot of defensive holdings, considering literally I have the highest risk profile I can have with Nutmeg. And I'd have the lowest ESG scores, and yet I had 20% in ESG in a generally very defensive portfolio. So I did get in touch with Nutmeg and was very disappointed that this was the best they could do, basically. So I've given myself an action over the next few months to sort of review SIP providers, private pension providers, and see whether we can introduce a bit more excitement and long-term risk ultimately into these. So it's nice to see that increase, right? It's $7,000 for not doing anything, and it is above my long-term performance expectations. But still, when the market was as nice as it was last year, it felt like my pension didn't take as much advantage of that as I would have liked. So that's that. And then yeah, everything else here is sort of moving in a broadly positive direction. Again, the other year on year looks a bit bad, but this is sort of timing around bonuses and things like that. So maybe January year on year isn't always the easiest and cleanest comparison because things tend to happen in January, taxes, that kind of stuff as well. And we should see a normalization over the next month or two as we do year on year comparisons. But still, January is always a funky month. Funky last year, funky this year. And so that's why I think the year-on-year comparison is a very nice thing to have as well. And yeah, specifically the other, as the year goes on and we start to build our emergency fund, again, we're primarily going to be building our emergency fund through premium bonds in the long term. So that gives us up to 100K in premium bonds for my wife and I. That's way more than we'll need for an emergency fund, but it's a nice way to store money cash effectively away from the market fluctuations and safely. And still, enjoy a reasonable return for that. So that's an important part for us, as well as contributing to our offset mortgage as well, which is in place and ultimately reduces our interest payments on our mortgage. So that's in place as well. But super happy with this breakdown. Things have more or less worked as expected. Our home value was rebased last year as well as part of a mortgage. So that was nice to have that. And I would expect really our ISAs over time to be the main wealth driver. That's pretty much because we're putting 40 grand a year into our ISAs and then they're seeing at least 8% growth. Actually, my long-term average so far across 3 years has been almost exactly 8%, so that's cool. Then our pensions, right? And again, our pensions will be a significant part, but we're not contributing 40 grand a year at this time to our pensions, so it will just never be able to catch up at our current run rate. And similarly with our home as well, like our home is basically about 25 grand a year addition to our wealth, and again, it just can't possibly catch up with our ISAs. So over time, the plan remains that we will be driven by ISAs. Tax-free income, should be a lot of tax-free income in the future, and we want to retire when we're 55, so before we can get access to private pensions. So again, especially important on our ISAs here. The only slight caveat is that my wife would like a forever home. This is sort of a new thing that isn't built into these projections over the next few years. So our current target is to potentially get a home in London by the time I'm 40 as an optimistic, and by the time she's 40 as a pessimistic. So that's 4 to 6 years. I think that's realistic. Well, like this is a lot of money even just to move. Would be like a 50 grand cost between stamp duties and solicitor fees and things like that. So that's a lot of money to burn effectively from my perspective. However, yeah, again, we're meeting our targets at the moment. My wife is making more significant contributions financially than I'd originally expected. And so if we do spend, 800 to a million on a home, then it would alter the dynamics here a fair bit across 20 years. So there's something for us to consider over the next few years. But the focus this year is basically building the emergency fund. It might not seem like that when we've just spent all this money on things like holidays, etc. But I think it was a mark of confidence that I had in our current position and the plan over the next 12 months that I felt comfortable with that cost. And now the plan is, like I say, you should see a fairly rapid increase in it over the next few months because we won't be putting anything into ISAs because we can't. So stay tuned, I guess, and we'll see again how this changes over the next few months and how the year-on-year comparison looks across the next few months as well. Okay, so in terms of capital added, just as a reminder, we've made this a bit broader as we diversify our investments. So we're now showing premium bonds and cash savings as well as withdrawing and net. So again, this looks a bit weird this month because obviously the cash savings in December were really good, almost 10 grand, and now we've withdrawn effectively 10 grand. And again, not a huge surprise because originally my wife was going to sort her tax in December, now sorted in January. So that was kind of a little bit of a mismatch in the numbers, as well as the holiday, as well as the fact that you'll see here the withdrawn figure is minus 10,500, but the trading 2-1 shares is positive 8.5, right? So those three things together basically made this situation what it was. Right at the very end of the month, I did put 2,000 back into our cash savings as well, so there was a little bit of sort of contouring there. But overall, it was a fairly low net addition to our capital added. To be clear as well, this figure excludes things like pensions, where we're not directly adding from our bank account. That sort of all happens before we're paid, right? So this table doesn't include that, hence the difference in the numbers. But again, I was kind of okay on this once we step back again. If we hadn't have had the holiday that we've already paid for, but that holiday is not till April, by the way, then this figure would be 4 grand higher. And again, a few other interesting exceptions as well. So I was actually most pleased I was still able to do £1,000 literally on the last day of the month. So hopefully that will qualify for the March draw. And as well as the big focus here of maxing out our ISAs felt amazing. So yeah, that was really great. And I'm really pleased with these numbers as well. And we should see them grow over time, similarly to more or less everything else as we're wealth building at the moment, right? Okay, so as I've said before, when I first started investing, I was really into dividends, but over the 3 years, I've realized I'm not a dividend investor. However, I'm not going to lie that receiving a dividend does feel really good, and I do like tracking it. Where we should hit £10,000 in total dividends at some time during 2024. I think that's a major milestone that we will celebrate. For now, we've exceeded 8,000, so that feels great as well. Also, as well, in the long term, like on the graphs, it doesn't look like necessarily our dividends growing that much. Especially compared to the amount of capital that we've been added to our ISA. And again, that's really a reflection that I'm no longer looking for dividend stocks. I'm quite happy to hold non-dividend paying positions or very low yielding positions. I'm much more concerned about the overall return. As an example, my second largest position returned 44% last year and doesn't pay a dividend, right? I'd much rather have 44% capital growth in my position than a 5% dividend yield and a 3% stock growth, right? That to me is less ideal. So that said, however, 2023 did see a 36% of our total dividend received. So we've basically got 3 full years at this point. So it has been sneaking up. In 2021 we had 27.5, 22, 34, and in 23. 36%, and you can sort of see the month by month breakdown there. So I like those figures. It's still moving in the right direction and shows that over time, newer years are accounting for a bigger share of the dividend, which again we should still expect. Less of a jump between 22 and 23, in part because of the fact that we were, again, changing the way we invested and less focused on yields, etc. So despite a very large increase in capital contributions as well as stock performance, the dividend didn't go up that much, but still dividends are nice to receive as and when. The other nice thing happened when I got my first dividend of the month, which was Fidelity Special Values. I describe this as a UK focused value position. I think the UK stock market at the moment represents significant buying opportunities, frankly. I'm very happy to be buying Fidelity Special Values. I do also have Throckmorton, which is what I would class as UK focused quality companies. That's actually got several of my holdings in as well, like Gamma and Games Workshop. Are both fairly large holdings in that. But again, I'm fine having duplicated positions of such high quality companies. Fidelity Special Values, I have much less overlap, to be fair. But again, this was it's 5% discount against its net asset value. I was buying just before dividend was paid as well, which was fantastic. And since this dividend, I've actually increased my position by about a third. So next time I get this dividend, it should be nice. It is worth saying this dividend just pays out twice a year, so similar to most UK stocks. And this was what they call the final dividend. So that's like 2/3, and then the interim being a third. So we won't be getting £100 every 3 months, unfortunately, but still, we should get another £60 or so in 6 months' time, potentially more again as we've been adding to our position over that time as well. The other nice surprise for me this month was Disney. Now, if I'm honest with you, I'm a little bit skeptical about Disney. I realise in hindsight that what was meant to be a pretty sure bet from a incredibly well-run, diversified company has not turned into that at all. Disney, to me, looks a bit creatively lost at the moment. I'm looking forward, if that's the right words, to the next earnings update next week, I believe. And I'm actually considering selling this at a fairly sizable loss. Fairly sizable, 20% down at the moment. It would be about £600 that we would realise as a loss. But I want to review what the performance is like. And to me, I'm most nervous about a lack of new creativity. I also went to the Disney store with my daughter as part of spending some relatives' money, and I was pretty shocked at some of the markdowns, and the cost of things were way more reasonable than I was expecting, which to me is not a good sign as an investor. Fine sign as a customer, I was able to buy way more than I was expecting. But I was surprised at some of the cost of things and some of the write-downs that Disney were apparently doing, especially obviously when you compare it to the extortionate cost, frankly, of things like their parks, their cruises, where Disney are still monsters, right? They still make good money on those things. They're still extremely popular. My concern is the kind of like part of the reason that I chose Disney over Netflix, a mistake, by the way, was because I liked the idea that Disney could have these like converging and building and cumulative wins, like the studios would be firing creatively, that would feed into amusements, that would feed into sort of their retail offering. It would all come together and kind of be a virtuous cycle, and that would drum up demand for sequels and spin-offs and everything else. And the sequels and spin-offs have just been pretty rubbish. And the new stuff that's coming in, Disney got involved in a lot of political spats as well and all that kind of thing. I think is very ugly for a company. So I may want to bite the bullet, but for now, this is basically a nice surprise for Disney. I guess they wanted to show that they're kind of okay as a business. It's more of a small gesture than a meaningful dividend. So we will take it in that way, and we're much more interested in terms of the performance. I would also point out as well Medical Properties, which was my worst performing share last year and is my second worst performing share ever. Is also again very much red at the moment. I'm not even quite sure what to do with it. To me, I always feel like I'm behind the market, and I just feel like, yes, okay, it's less valuable than it was a few years ago, but it still doesn't look expensive to me. So it still feels like the wrong move to sell it, even though obviously it's going through a lot of difficulties at the moment. It does look to me incredibly cheap, but obviously we will see what happens with that over time. I would say as well that I am ring fencing my risk at the moment, so I'm not reinvesting Medical Property into itself. You could argue that that's not the right thing to do, right? If I'm confident it's undervalued, I should reinvest. However, I heard a very similar argument about Evraz, our Russian miner, a couple of years ago now, and that didn't work out so well for me, where I reinvested dividends and even after the event, and that didn't work out so well. So we've decided to hold this and ring fence our risk, and any dividend we receive is basically going elsewhere. I guess not a ton more to mention here, just a few other dividends as things start to get up and running, but very pleased actually with our January because year on year again, there's some good growth against it. So we're pretty happy with these dividend figures. And what will happen over the next few months, especially once we get into spring, is that all of my UK shares that yield twice a year will start to pay. February should still be pretty okay, but I don't expect it to be quite as good as last year. Last year had specials from Hollywood Bowl and Games Workshop. Actually, Hollywood Bowl is again doing a special this year, which it will help. And Games Workshop is also doing their dividends as well, which are solid, but I have a smaller position in Games Workshop this year. And overall, it will just be a slightly quieter month than previous. But again, as we get into the spring period and the UK shares start to yield, then we should see a modest increase year on year, similar to what we've been seeing for the last couple of years now. Okay, so in terms of things to do for 2024, we were off to a pretty decent start with our admin. So I did do a review of my wife's pension contribution related to her new salary. I exchanged a few emails via my wife and her HR payroll department. My wife's employer is American, even though they pay in pounds and operate over here in the UK. But it does mean that they have some fairly atypical benefits, pay, etc., to what I would typically expect. The unusualness here is that they do 6% of my wife's salary regardless. It doesn't matter if she matches it, exceeds it, it just is 6%. And that's that. Normally you would have pension matches and things like that capped at a certain level. But that isn't what hers do, which is okay. 6% is not huge, but not bad by UK standards. I have seen a few worse. I would say it's nothing special, but again, her package and bonus kind of makes up for it. So that's also fine. Again, I think it's a slightly different salary model that they've adopted, which again is quite okay for me and my wife because it's complementary to what we have to each other. So what this really meant, long story short, is that she will be adding her £128 each month to her total pension contribution. That's tax, employer, and employee, which is a 17% increase. This is good for me just because I would like my wife's pension to be a little bit bigger. She was quite late to get started. My wife has a doctorate, and hasn't been pensions in general haven't been a focus for us. But my wife also had education to go alongside that. And now that she's earning pretty good money, it's an opportunity for us to add to our wealth via her pension ultimately. So that's good. We didn't get started on the Hargreaves Lansdown Junior ISA, but we will do. That's been going on for 3 months. So I really need to sort of push both Nutmeg and Hargreaves to get that moving quicker. The nice surprise here, which I wasn't originally planning to do until March, is to complete our ISAs. And I mentioned this in my portfolio video, but the reason here is that since Trading 212 introduced their 5% for any cash held, it just meant that I may as well put it in there to max it out. I couldn't do any better elsewhere, and so we've now got quite large cash deposits in our ISAs that we're just running down over time and enjoying, a daily interest of about £1.50 at the moment. It doesn't sound much, but every day I get these little notifications, and times it by 30. And suddenly it's approaching 50 quid a month just in, cash held in our ISAs. So that it does feel nice, honestly. It's quite motivating. It's like the dividends. It's not primarily what's going to make me rich, but I must admit there's a warm fuzziness when I log in and I see, oh, your interest paid on your cash. It's like, oh, that's nice. So the fact it's daily as well is quite motivating, even though it's for a very trivial amount. It punches above its weight, shall we say, in terms of the actual financial and emotional contribution. Then we've got our private pensions here. So I might bring this forward, especially after the pension performance conversation that we had earlier. I was considering moving away from Nutmeg anyway, especially for my pension, which is above 75,000. The fees are less competitive or less good against the competition within Nutmeg once it gets above 75k. So other pension providers have better management fees at that kind of level, and I've been considering again moving away from on the good side is a very easy way to invest in Nutmeg, right? You have a very few options, you pick your fund, it's a nice easy to use portal and etc. And especially when I was buying individual shares in my ISAs and getting used to everything, that was very comforting to me, the fact I didn't have to worry. Now the situation's reversed where I can no longer buy individual shares because of my wife's private equity employer. And so I'm looking for a little bit more excitement potentially in my pension, where it's okay, maybe I can start buying investment funds and ETFs and other things as well, and hopefully improve on that performance. So that's my thinking there, basically a combination of those two things. And we'll try and move this up a little bit, but life is very busy at the moment, so I'm not super optimistic. We'll aim for April. That was the original plan, and we'll try and stick with it. And then building our emergency fund here, 35k. Again, it's very low at the moment. It's effectively 2,000 because it's everything above our credit limit. But we do expect to add sort of 4 grand to it each month for the next 2 months, and then we'll sort of look to add, you know, several thousand to it each month as we go through the year. If I'm honest, maxing this out by the end of the year is an ambitious target. We would more or less have to hit our 100k total in order to meet this. But the important thing for me is, you know, we make a contribution toward it. Like our costs are apparently about 5 and a bit thousand per month. So getting to this level would give us a 6-month emergency fund that would feel very good. And again, we'll just put all of this more or less into premium bonds, enjoy our 4%, hopefully win £1 million, and we'll feel pretty good about that. So the important thing here really is that over the year we should make some progress toward this, just in case, right? And it'd be useful to have it there as well. So we'll see what the figure looks like in December. If there's a bit shortfall and we only have 4 months emergency fund, you know, 25,000, we'll still feel perfectly okay with that. 35k is obviously our full target for our current lifestyle. Again, living in London, mortgage, etc. This pays all of our bills ultimately for 6 months if we can get to this figure. So this is our target for the year, and we'll aim for that December, even though, again, I think it's a little bit ambitious. And as we've already touched on, 100k across the year, ambitious likewise, but we will do our best to achieve it. So that's everything. This is a bit of a longer video than I was expecting, but some background as we were talking. And again, January, a fairly unusual month, lots going on, but broadly happy with a fairly static month-on-month performance, and very ecstatic with the year-on-year performance as well. So that's everything from me. Thank you very much if you made it this far. I've been the Boss Hog, and good luck with your wealth building. Bye for now.